mean, I think the mood of the market is still pretty negative dollar on, let's say, a 1 to 3 month horizon. People are still expecting more from the Federal Reserve in terms of additional stimulus actions. And at the present stage, people logically or illogically seem to think that the Fed stimulus is dollar negative, while ECB stimulus is not sorry, euro negative. So this train, the momentum is still heading in a dollar weaker direction. So what we're seeing now is a technical retracement.
All right, so what's the best trade right now then? Would it be the euro?
I think actually right now in this retracement, what you want to do is you want to be long the safe haven currencies, so particularly Swissy and the yen, and buy it against some of the riskier EM currencies. In this risk-off phase, which we don't know, since this is FX, so we're sort of only talking about a 1 to 3 day horizon, you might want to buy some of those safe havens against EM.
Cliff, if the fundamental backdrop for the dollar is deteriorating, as you say, why have we seen such strength in the greenback in recent sessions?
The fundamental backdrop is, I don't actually think so. I don't actually think what happened last night and what's happening today is really much about fundamentals. The fundamentals haven't really shifted that much. I think the Fed's view is not too far from consensus, and people understand that this climb out of the pandemic, this is the biggest macro shock that most of us have ever seen in our lifetimes and probably will ever see in our careers. So the climb back, the key question is, can it all be over this year? I'm one of those guys who don't think it is. I think it's going to be a multi-year climb back. And so from that point of view, I don't think the fundamentals have shifted that much. I think the dollar is always, a safe haven whenever people get too nervous about the pandemic outlook. And so last night, we had yesterday and last night, and we had this concern about the second wave. Now, we don't actually think that, what's going on, particularly in the U.S., is the second wave. It's actually still part of wave one. And certainly what's happening in Latin America is still part of wave one. It's just that the markets haven't taken notice before.
The other interesting thing, and you alluded to this, Cliff, it's that the Fed chair essentially suggested that we're going to see a 2, perhaps a 3-year run rate to normalization here. And clearly rates are going to stay low in the United States throughout the course of that period. At the same time, there's renewed fears about a second wave of the virus before the United States even has the opportunity to deal with the first. What do you think that means moving forward for risk assets, particularly in the FX landscape, if the Treasury Secretary does indeed stay good with his pledge and decide to go hand in hand to Congress to ask for more money for additional stimulus? Do you see that as likely, and how would it impact the risk assets that you watch? Would it be negative or positive?
Well, I mean, I think, in the over this 2 to 3 year horizon, until we get to a place of safety, say with a vaccine, it's really not logical to have risk assets at the levels that they are right now. So, for example, if we were to have a second wave, it's not so much that things will collapse as much as they did in the first wave, but it's just that company operations will be affected and profits will be affected. So, therefore, the valuation of many of these assets, credit and equities, will come into question. So I think, I think almost certainly the U.S. is good for at least another round. It's an election year, around another round of stimulus. So it's hard to see politicians not doing something. So they'll go not so much hand in hand. I think everyone's kind of on the same page here, but they'll roll something out, and then the Fed will do something supportive on that. But it's still, at the end of the day, triage. It's not a solution to the economic collapse. I mean, we've written, before that, governments can spend 10% of GDP or even 20% of GDP. They can't spend 100% of GDP. Otherwise, you don't have an economy anymore. You just have the government writing checks.
Let's go over to China. What about the Chinese yuan? Because we've been seeing that hitting record lows in the last few weeks, bouncing back, but the data coming out of China is still patchy at best.
Yeah, so, what we think, again, as the Chinese authorities alerted us to several years ago, you want to watch the CFETs. So what's been much more notable than the bilateral exchange rate against the dollar is that CFETs has really weakened quite a bit over the last month or two. Now, if you use the index from last year, which I've been watching because I think it's what matters to the U.S.-China tensions, I mean, we've gone from like 93 and change back down to the low 90s, sort of on the higher end of the 90 range. And so, the weakening that you need in the renminbi to support, what export momentum there is in the remainder of the year, I think it's already taken place. I mean, it's a pretty prudent policy from the point of view of the Chinese authorities. And that prudency is going to extend over to the bilateral exchange rate because I don't think they really want it below 7. I mean, I think the rally that we've seen in the renminbi, if you look at it, is much less than in other emerging Asian currencies, particularly the Korean won. And that just speaks to, I think, the underlying caution of the PBOC.